Hello everyone, welcome to the 35th episode of me learning how to trade using Forex. So in the last video we went through the baby Pips website and we were working on the Pipsology or School of Pipsology lesson, I guess, and we're currently doing the preschool bit, and we left off with Forex market size and liquidity. So yeah, let's get started on that then. So Forex market size and liquidity. The bulk of Forex trading takes place on what's called the interbank market. Unlike other financial markets like the New York Stock Exchange or London Stock Exchange, the Forex market has neither a physical location nor a central exchange. So the Forex market has no physical location or central exchange. The Forex market is considered an over-the-counter market due to the fact that the entire market is run electronically within a network of banks and non-bank financial institutions continuously over a 24-hour period. Considered a over-the-counter market. As it's run electronically. This means that the FX market is spread all over the globe with no central location. Traders can take place anywhere as long as you have an internet connection. Cool. The Forex over-the-counter market is by far the biggest and most popular financial market in the world, and it is traded globally by a large number of individuals and organizations. In an over-the-counter market, participants can be picky and determine who they want to trade with depending on trading conditions. The attractiveness of prices and the reputation of the trading counterparty, the other party who takes the opposite side of your trades. The chart below shows the 7 most actively traded currencies. So we've got the dollar, the euro, the yen, the pound, the Aussie dollar, the franc, the dollar, the Canadian dollar, and the others. Because 2 currencies are involved in each transaction, the sum of the percentage shares of individual currencies totals 200% instead of the 100%. The US dollar is the most traded currency, making up 84.9% of all transactions. The euro's share is second at 39.1%, while that of the yen is third at 19%. As you can see, most of the major currencies are hogging the top spots on this list. The dollar is king in the Forex market. You've probably noticed how often we keep mentioning the US dollar. If the USD is 1/2 of every major currency pair, and the majors comprise 75% of all trades, then it's a must to pay attention to the US dollar. The USD is king. Currency composition of the world's FX reserves, so most of it is US dollar, yep. In fact, according to the International Monetary Fund, the US dollar comprises roughly 62% of the world's official foreign exchange reserves. Foreign exchange reserves are assets held on reserve by a central bank in foreign currencies. So, was it foreign exchange reserves are assets held on reserve by a central bank in foreign currencies. So let me just read that again. Foreign exchange reserves are assets held on reserve by a central bank in foreign currencies. Right, so it's not the currency that the bank is in or located in. So for example, if the bank was in London, then the foreign current exchange reserves might be in US dollars or Japanese yen. Because almost every investor, business and a central bank own it, they pay attention to the US dollar. There are also other significant reasons why the US dollar plays a central role in the forex markets. The United States economy is the largest economy in the world. The US dollar is the reserve currency of the world. The United States has the largest and most liquid financial markets in the world. The United States has a stable political system. The United States is the world's sole military superpower. The US dollars represent about half of the international loans and bonds. Lots of countries and foreign companies borrow in USD. The US dollar is a medium of exchange for many cross-border transactions. For example, oil is priced in US dollars, also called petrodollars. So if Japan wants to buy oil from Saudi Arabia, it can only be bought with the US dollars. If Japan doesn't have any dollars, it has to sell its yen first and buy US dollars. America. Basically, the world is heavily dependent on continuous US dollar supply to facilitate trades, payments and loans. The US dollar has more interest from global banks than any other currency. It's the most commonly held denomination among foreign bank assets, which include loans and other USD denominated securities, with a balance of around 16.7 trillion in most recent data. Speculation in the forex markets. The main functions of the forex markets are to transfer funds from one currency of a country to another currency, to provide short-term credit to finance trade between countries, to avoid or hedge against foreign exchange rate fluctuations from when a transaction is initiated and when payment is received, to speculate. One important thing to note about the forex market is that while commercial and financial transactions are part of the trading volume, most currency trading is based on speculation. In other words, most of the trading volume comes from traders that buy and sell based on the short-term price movements of currency pairs. The trading volume brought about by speculators is estimated to be more than 90%. The scale of the forex market means that the amount of buying and selling volume happening at any given time is extremely large. So, most of the trading in forex is speculation, which is so traders buy and sell based on the short-term price movements of currency pairs. The scale of the forex market means that the amount of buying and selling volume happening at any given time is extremely large. This makes market liquidity, which is the ability to buy or sell a large quantity of something with minimal price impact, very high. So market liquidity, which is the ability to buy or sell something, a large quantity, sell a large quantity of something with minimal price impact. The increase in market liquidity since the 1970s has yielded many benefits. From the perspective of a short-term trader, liquidity is very important because it determines how easily a price can change over a given time period. A liquid market environment like Forex enables huge trading volumes to happen with very little effect on the price or price action. While the Forex market is relatively very liquid, the market depth could change depending on the currency pair and time of day. In our Forex trading sessions, part of the school, we will explain how the time of your trades can affect the pair you're trading. In the meantime, let's learn about the different ways that individuals can trade currencies. Next lesson, how to trade Forex. Yep. How to trade Forex. How do people participate in the Forex market? So far you've learned what the Forex market is, how big it is, the different types of currencies and how they are sold in pairs. But how do you trade Forex? Let's now take a look at how to participate as a trader. How to trade Forex. Because Forex is so awesome, traders come up with a number of different ways to invest or speculate in currencies. Among the financial instruments, the most popular ones are retail Forex, spot FX, currency futures, currency options, currency exchange traded funds or ETFs, Forex CFDs and Forex spread betting. Ooh, this is a so let's do that. Copy, paste. Remember it's 49.99. That looks good. It's important to point out that we are covering the different ways that individual retail traders can trade FX. Other financial instruments like FX, swaps and forwards are not covered since they cater to institutional traders. With that out of the way, let's now discuss how you can partake in the world of Forex. Currency futures. Futures are contracts to buy or sell a certain asset at a specific price on a future date. That's why they're called futures. Right, okay, so futures. Contracts to buy or sell a certain asset at a specific price on a future date. A currency future is a contract that details the price at which a currency could be bought or sold and sets a specific date for the exchange. Currency futures were created by the Chicago Mercantile Exchange way back in 1972 when bell-bottoms and platform boots were still in style. Since future contracts are standardized and traded on a centralized exchange, the market is very transparent and well regulated. This means that price and transaction information are readily available. You can learn more about CME's FX futures here. Currency options. An option is a financial instrument that gives the buyer the right or the option, but not the obligation to buy or sell an asset at a specific specified price on the option's expiration date. Right, okay, so options. Or option gives the buyer the right, the option, let's just say, but not obligation to buy or sell an asset at a specified price on the option's expiration date. If a trader sold an option, then he or she would be obliged to buy or sell an asset at a specific price at the expiration date. So if a trader sold an option, then he or she would be obliged to buy or sell an asset at the specified price of the expiration date. So if the trader sold an option, then he or she would then they would be obliged to buy or sell an asset at a specified price at the expiration date. Just like futures, options are also traded on an exchange, such as the Chicago Mercantile Exchange, the International Securities Exchange, or the Philadelphia Stock Exchange. Options are also traded on an exchange, such as However, the disadvantage in trading FX options is that the market hours are limited for certain options, and the liquidity is not nearly as great as the futures or spot market. So market hours are limited for certain options, and the liquidity is not nearly as great as futures or spot markets. Currency ETFs. A currency ETF offers exposure to a single currency or basket of currencies. So currency ETFs offers exposure to a single currency or basket of currencies. Currency ETFs allow ordinary individuals to gain exposure to the Forex market through a managed fund without the burdens of placing individual trades. Okay, so it's managed. Allows ordinary individuals to gain exposure to the Forex market through a managed fund without placing individual trades. Currency ETFs can be used to speculate on Forex, diversify a portfolio, or hedge against currency risks. Here's a list of the most popular traded currency ETFs. Diversify or hedge against currency risk. So can be used to speculate on Forex, diversify a portfolio, and hedge against currency risks. Here's a list of the most popularly traded currency ETFs. ETFs are created and managed by financial institutions that buy and hold currencies in funds. They then offer the shares of the fund to the public on an exchange, allowing you to buy and trade these shares just like stocks. Like currency options, the limitation in trading currency ETFs is that the market isn't open 24 hours. Also, ETFs are subject to trading commissions and other transaction costs. So, however, market isn't open for 24 hours, and ETFs are subjected to trading commissions and other transaction costs. Spot FX. The spot FX market is an off-exchange market, also known as over-the-counter marketing. spot FX, off exchange market, and off exchange market, an off exchange / over the counter market. The off-exchange forex market is a large, grown and liquid financial market that operates 24 hours a day. Operates 24 hours a day. It is not a market in the traditional sense because there is no central trading location or exchange. In an over-the-counter market, customers trade directly with a counterparty. A customer trades directly with a counterparty. Unlike currency futures, ETFs, and most currency options, which are traded through centralized markets, spot FX are over-the-counter contracts, private agreements between two parties. Most of the trading is conducted through electronic trading networks or telephone. The primary market for FX is the inter-dealer market, which FX dealers trade with each other. A dealer is a financial intermediary that stands ready to buy or sell currencies at any time with its clients. The inter-dealer market is also known as the interbank market due to the dominance of banks as FX dealers. Wait a second, this is a lot. Wait, so over-the-counter market, customers trade directly with a counterparty. Customers trade directly with a counterparty. Unlike centralized futures, which are traded with centralized markets, so there is no centralized markets. Spot FX are over-the-counter contracts. So no central trading location. No central trading location. So it's private agreements between two parties. Most of the trading is conducted through electronic trading networks or telephone. The primary market for FX is the inter-dealer market, where the FX dealers trade with each other. A dealer is a financial intermediary that stands ready to buy or sell currencies at any time with its clients. So, primary market for FX is the inter-dealer market, where FX dealers trade with each other. The prime market for FX is the inter-dealer market, where the FX dealers trade with each other. A dealer is a financial intermediary that stands ready to buy or sell currencies at any time with its clients. So, a dealer is a financial intermediary which is ready to buy or sell currencies at any time with its clients. The inter-dealer market is also known as the interbank market due to the dominance of banks as FX dealers. The inter-dealer market is only accessible to institutions that trade in large quantities and have very high net worth. Right, okay, so inter-dealer market is only available to institutions that trade in large quantities and have a high net worth. This includes banks, insurance companies, pension funds, large corporations, and other large financial institutions manage the risk associated with fluctuations in currency rates. In the spot FX market, an institutional trader is buying and selling an agreement or contract to make or take the delivery of a currency. So, in spot FX, an institutional trader is buying and selling an agreement or contract between to make or take delivery of a currency. In a spot FX market, an institutional trader is buying and selling an agreement or contract to make or take a delivery of a currency. A spot FX transaction is a bilateral agreement to physically exchange one currency against another. Also, it's physical. Spot FX. Physically exchanges one currency against another. This agreement is a contract. This means that the spot contract is a binding obligation to buy or sell a certain amount of foreign currency at a price that is the spot exchange rate or the current exchange rate. So if you buy the euro dollar on a spot market, you are trading a contract that specifies that you will receive a certain amount of euros in exchange for US dollars at an agreed upon price or exchange rate. It is important to point out that you are not trading the underlying currencies themselves, but a contract involving the underlying currencies. Right. So, let me delete that then. Fix, doesn't trade the underlying currencies, but a contract involving the underlying currencies. Even though it's called spot, transactions aren't exactly settled on the spot. This agreement is a contract. In reality, while the spot FX trade is done at the current market rate, the actual transaction is not settled until 2 business days after the trade date. This is known as T+2, today plus 2 business days. It means that delivery of what you buy or sell should be done within 2 working days and is referred to as a value date or delivery date. For example, an institution buys the euro dollar in the spot FX market. The trade opened and closed on Monday has a value date on Wednesday. This means that it will receive euros on Wednesday. Not all currencies settle T+2 though. For example, USD, CAD, USD, TRY, USD, RUB and USD PHP value date is T+1, meaning 1 business day going forward from today. Trading in the actual spot Forex market is not where retail traders trade though. Oh. Well, okay. That's in the spot Forex market is not where retail traders trade. Okay, that's very good to know. Retail Forex. There is a secondary over-the-counter market that provides a way for retail, i.e. poor, i.e. normal traders, to participate in the Forex market. Access is granted by so-called Forex trading providers. Forex trading providers trade in the primary over-the-counter market on your behalf. They find the best available prices and then add a markup before displaying the prices on their trading platforms. This is similar to how retail stores buys inventory from a wholesale market, as a markup, then shows a retail price to their customers. Forex trading providers are also known as Forex brokers. Technically they are not brokers, because a broker is supposed to simply act as a middleman between the buyer and the seller, between two parties. But this is not the case, because a Forex trading provider acts as your counterparty. This means that if you are the buyer, then it acts as a seller, and if you are the seller, it acts as a buyer. To keep things simple for now, we will still use the term Forex broker, since that's what most people are familiar with, but it's important to know the difference. Right, okay. Although a spot Forex contract normally requires delivery of a currency within 2 days, in practice nobody takes delivery of any currency in Forex trading. The position is called rolled forward on the delivery date, especially in the retail Forex market. Remember, you're actually trading a contract to deliver the underlying currency rather than the currency itself. It's not just a contract, it's a leveraged contract. Retail Forex traders can't take or make money on leveraged spot Forex contracts. Leverage allows you to control large amounts of money for a very small amount. Retail Forex traders brokers lets you trade with a leverage, which is why you can open positions valued at 50 times the amount of initial required margin. So with $2,000 you can open a Euro USD trade valued at 100,000. Imagine if you went short Euro USD and had to deliver £100,000 worth of euros. You'd be unable to settle the contract in cash, since you only have 2,000 in your account. You won't have enough funds to cover the transaction. So you either have to close the trade before it settles or roll it over. To avoid this hassle of physical delivery, retail Forex brokers automatically roll client positions. Jesus, is a lot. So why is this so long? So retail Forex, right, okay. Retail Forex. Secondary over-the-counter markets that provides a way for retail traders to participate in the Forex market. Let's see, how do I word this? Provides a way for retail traders to participate in the Forex market through a Forex trading broker or Forex trading providers. This is similar to, okay, yep. Although a spot Forex contract normally requires delivery of currency within 2 days, in practice nobody takes delivery of any currencies in Forex trading. The position is rolled forwards on the delivery date, especially in the retail Forex markets. Remember, you are actually trading a contract to deliver the underlying currency rather than the currency itself. It's not just a contract, it's a leveraged contract. Retail Forex traders can't take or make delivery on leveraged spot Forex contracts. Leverage allows you to control large amounts of currency for a very small amount, yep. Retail Forex brokers lets you trade with leverage, which is why you can open positions valued at 50 times the amount of initial required margin. allows you to control large amounts of money using a small amount. So if 2000, imagine if you went short, yep. To avoid this hassle, the retail automatic roll client positions, right? When a spot forex market transaction is not physically delivered but just indefinitely rolled forwards until the trade is closed, it is known as a rolling spot forex transaction or rolling spot FX contract. In the US, the CFTC calls it a retail forex transaction. This is how you avoid being forced to accept or deliver 100,000 euros. Retail forex transactions are closed out by entering into an equal but opposite transaction with your forex broker. Transactions are closed by entering an equal but opposite amount. Opposite transaction. For example, if you bought British pounds with US dollars, you would close out the trade by selling British pound for US dollars. This is also called offsetting or liquidating a transaction. Also called offsetting or liquidating a transaction. If you have a position left open at the close of a business day, it will be automatically rolled over to the next value date to avoid the delivery of the currency. Your retail forex broker will automatically keep on rolling over your spot contract for you indefinitely until it is closed. The procedure of rolling the currency pair is known as tomorrow next or TOM next, which stands for tomorrow and the next day. When positions are rolled over, this results in either interest being paid or earned by the trader. Are rolled either interest or being paid or earned by the trader. A position will automatically roll over into the next day when the business day is over. These changes are known as a swap fee or rollover fee. These charges are known as a swap fee or rollover fee. Your forex broker calculates the fee for you and will either debit or credit your account balance. Retail forex trading is considered speculative. This means traders are trying to speculate or make bets on and profit from the movement of exchange rates. They're not looking to take physical possession of the currencies they buy or deliver the currencies they sell. Forex spread bet. Spread betting is a derivative product, which means you don't take ownership of the underlying asset, but speculate on whichever direction you think its price will move up or down. A Forex spread bet enables you to speculate on the future price action of a currency pair. A currency pair's price being used on a spread bet is derived from the currency pair's price on the spot FX market. Your profit or loss is dictated by how far the market moves in your favour before you close your position and how much money you have bet per point of price movement. Spread betting on Forex is provided by spread betting flow providers. Unfortunately, if you live in the US, spread betting is considered illegal. Despite being regulated by the FSA in the UK, the US considers spread betting to be internet gambling, which is currently forbidden. Forex CFD, a contract for difference, is a financial derivative. Contract for difference. Derivative products track the market price of an underlying asset so that traders can speculate on whether price will rise or fall. The price of a CFD is derived from the underlying asset's price. Derivative products track the market price. A CFD is a contract typically between a CFD provider and trader. Between the trader, where one party agrees to pay the other the difference in value of a security between the opening and closing of a trade. Where one party agrees to pay the other the difference between the difference in value of a security between the opening and closing of a trade. In other words, CFD is basically a bet on a particular asset going up or down in value. With the CFD provider and you agree that whoever wins the bet will pay the other difference between the asset's price and when you enter the trade and its price when you exit a trade. So essentially a bet on a particular asset going up or down in value. A Forex CFD is an agreement to exchange the difference in the price of a currency pair from when you open your position versus when you close it. So an agreement to exchange the difference in the price of a currency pair from when you open the trade to when you close the trade. A currency pair's CFD price is derived from the currency's pair price on the spot FX market, or at least it should be. If not, what is the CFD provider they are basing its price on? Trading Forex CFDs gives you the opportunity to trade a currency pair in both directions. You can take both long and short positions. If the price moves in your chosen direction, you would make a profit, and if it moves against you, you make a loss. In the EU and UK, regulators decide that rolling spot FX contracts are different from the traditional spot FX contract. The main reason being is that with rolling spot FX contracts, there is no intention to ever take actual physical delivery, take ownership of the currency. Its purpose is to simply speculate on the price movement in the underlying currency. The objective of trading a rolling spot FX contract is to gain exposure to price fluctuations related to the underlying currency pair without actually ever owning it. So to make this differentiation clear, a rolling spot FX contract is ruled as a CFD. In the US, CFDs are legal, so it's known as a retail Forex transaction. Forex CFD trading is provided by CFD providers Outside the US, retail forex trading is usually done with CFD or spread bets. Right. Okay. Oh, there's some quiz now. Okay. The foreign exchange market is a global. It allows you one pair false. Forex is a global decentralized market. It allows you to trade two currencies against each other. If you think one currency will be stronger versus the other and you end up correct, then you can make a profit. Yep. What is the largest financial market in the world? Forex. The foreign exchange market, which is usually known as Forex or FX, is the largest financial market in the world. Yep. If the Forex market is the largest financial in the world, how big is it? That isn't it? 6 trillion. The foreign exchange market does 6.6 trillion of trading volume each day. This is ginormous compared to the 22.4 billion trading volume of New York Stock Exchange each day. How many letters in currency symbol? 3. First two letters identify the name of the country. Third letter identify the name of the country's currency. Yep. Which of the following is not a major currency pair? So all the major ones must have US dollars in. This one doesn't have US dollars. Yep. Which one of the following is another nickname for USD? Cable, isn't it? Yeah. What type of markets are Forex markets? Over-the-counter markets. The entire market is run electronically. What do you call a currency pair? Because there's one major currency and one exotic. The most active traded crosses are derived from the 3. That one. What does CME stand for? Chicago Mercantile Exchange. The dollar is king in the Forex market prime because 1/2 of every major currency pair, and the majors comprise 75% of all trades. But here are other significant reasons why US dollar plays a central in Forex markets. Largest economy. What is the second most traded currency? Euros, isn't it? Yep. The one most important thing to note about the Forex market is the currency trading is based on speculative. True. What do you call a contract that details a price at which a currency could be bought or sold and sets a specific date, future. What do you call a financial instrument that gives the buyer the right or the option but not the obligation to buy? That's an option. 86%. What did I get wrong? What is trading Forex? Buck. Because every... Oh, is it multiple choice? Whoa, what's this? Okay. Cool. Next lesson, how to make money trading Forex. Okay, I am gonna leave this episode here. Thank you for watching. I'll see you guys in the next video, which is how to make money trading Forex. Bye.